Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Nike reported some numbers, some better than expected numbers. Stocks up almost 5%, although it's still down about 3% year to date, but maybe a little bit of a turnaround there. Working through the inventory, as some smart folks have told me about the Nike story. One of those is Poonam Goyal. She's a senior U.S. e-commerce and retail analyst for Bloomberg Intelligence. Poonam, is the turnaround at Nike, is it kind of turning? Is it working?
It's working. I think yesterday was the first sign that Nike is able to pick up momentum. Sales on a reported basis were up 1%. Inventories were down 2%. This is exactly what we wanted to see. We wanted to see inventories align with sales. So while the work isn't done and it's not over and it's not a straight line up, we do see momentum building. What they're doing is working. The new products, the innovation, the focus on wholesale, it's all coming together. There are still some pitfalls. China is still sluggish, and we'll need to wait and see what happens there, as well as with its Converse brand.
Okay, so China's definitely an issue. Converse is a work in progress. When I look at the revenue line, the top line, what I see is direct revenue fell 4%, wholesale revenue rose 7%. Just break that down for us in terms of what that means, direct revenue versus wholesale revenue.
Sure. So direct revenue composes of stores, which were actually up 1%. So that shows us that the innovation and the new products which are flowing through their own stores is working. What made the DTC revenue go down 4% was that digital was down 12%. No surprise here. This is where they're clearing all that excess inventory. So this channel will be pressured for a couple of quarters still. Wholesale up 7%, a great number. I mean, it just shows that coming back into partnerships with Foot Locker in a more meaningful way, getting on Amazon.com, all these efforts are paying off, and they're where the customer is. They're gaining their shelf space back, and the customers are responding favorably.
You know, the Nike brand is such a powerful brand. I think of it like Coca-Cola or Apple. It's so powerful. Yet some of those American brands in China, under pressure. And I'm wondering, just with the geopolitics, is Nike a brand where that might be feeling some anti-American sentiment from consumers?
So that has happened in the past. There have been boycotts against, U.S. American brands. We don't think that's the issue yet, from what we're hearing. But we do think that the issue is more product at Nike in China. So they do need to ramp up product, and they do have a lot of excess inventory there, more so than they do in the US today. So that's also a work in progress that they need to get through.
Let's talk about profitability. Margins declined due to higher discounts and then also the higher tariffs in North America. I look at gross margin, 42.2%. Last year at this time, it was more than 45%. Now, the 42.2% was better than estimated. How long is it going to take for Nike to turn that around?
I think we have quite some time to get back up to historical margins. In fact, on the call yesterday, they said that they do still aspire to reach double-digit EBIT margin. EBIT margins in the quarter that they just reported was only at 7.1%. So that's a long runway. We don't think it's anytime soon. And the hit from tariffs is building, not reducing. They had expected $1 billion the last time they spoke to us, and yesterday that went to $1.5 billion in excess costs from tariffs.
How much are they passing along to the retailer versus taking that in their margin? Because, I mean, Nike is probably just a great example of how companies are trying to deal with the tariffs.
Yes, I think they're doing this actually very smartly. They're not increasing prices on products that are under $100, but they are taking prices up on sneakers that are above that price point. So if you think about moving prices up, it's very easy to say the price of milk went up from $3 to $3.50. But when you're looking at a pair of sneakers, especially a new launch, you have no comparison. So you can go ahead and price up your new innovation, and the customer may not even recognize that there was a material price increase. And that customer has a little bit more flexibility to stretch their wallets at that price point.
Poonam, if you are heading up On Holdings or Adidas or Skechers or, any of the Hoka, what would you be thinking looking at this set of results?
So Skechers, I think, is in a different league than Nike. It's a little bit different. It's a value play, and I think they don't compete directly like an Adidas or an On or a Hoka would with them. Adidas is doing really well on its franchise lifestyle shoes, and I think Nike, what you heard yesterday, was doing well in performance. So two still very distinct categories. Though for On and Hoka, I think it's a little bit of a different story because what I heard from that call yesterday was that running was back on. It's doing phenomenally well. And that is where Hoka and On both took share from Nike. So I would be just, a little concerned and just make sure that I keep my game on when it comes to innovation, because at the end of the day, product is what's going to drive how sales momentum will go moving forward.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Another IPO priced here. Neptune Flood Insurance, NP is the ticker. And joining us from the New York Stock Exchange floor is Trevor Burgess. He's the CEO. Trevor, thanks so much for joining us here. Congratulations on the IPO. It's priced at $20. I'm looking at the Bloomberg terminal now. We got a bid of 22.5 and the ask of 22.75. So maybe they'll finally get this thing opened. If I were running your deal, Trevor, I would have had this open at 10:30, no later. Trevor, talk to us about your business model. Flood insurance. You guys have exposure to Florida. Nobody provides insurance in Florida. What's your business model?
Yeah, so Neptune is an artificial intelligence company that does a really good job at underwriting flood risk for global insurance and reinsurance companies. So we don't actually take the risk. We build technology that does a really good job at analyzing that risk and making sure it's something that the global insurance markets want to take on, which makes us the largest competitor to the National Flood Insurance Program, which is the federal government's program, which was the only way to buy flood insurance for a long time until Neptune came along. Happens to be that the government's closed today, so Neptune is the only game in town right now, which is exciting for us, obviously, because we want to help those 1,300 consumers who are trying to buy their house today and who need flood insurance. We're the solution.
So, Trevor, let me ask you, there's been a lot of complaints about the federal flood insurance program. What is broken with it? Why is it something that people are not on board with or people can't get when they need?
Well, there are a couple of ways to look at the NFIP's problems, but the biggest one is that they've lost nearly $40 billion in their history. They're paying millions of dollars a day in debt payments to the U.S. Treasury. So it's just an unsustainable program. And it doesn't offer a product that consumers want. They only go up to $250,000 of coverage on your house. Neptune offers up to $7 million of coverage. We'll also cover your Airbnb or your hotel if you're flooded out of your room. If you are with the NFIP, you're just out of luck. If you have a flooding, there's no money for that hotel.
So who are your clients, Trevor? Are they the insurance companies and reinsurers themselves?
We get to have two clients. We serve those global insurers and reinsurers who are looking to put money to work in the flood insurance space. And importantly, our customer is the American homeowner and business owner. We provide residential and commercial policies to protect your home. We compete with the NFIP every day that they're open. Today, they happen to be closed.
Fair enough. In terms of which states are most affected, Paul mentioned obviously Florida, but is there, floods seem to happen.
New Jersey?
Yes, floods seem to happen to every state, including those that are inland. Is there any area in the country that is, more relatively shielded from flood risk?
Not really. If it can rain where you live, then it can flood. And we saw that in the month of July. There were major floods in 23 states in this nation. That means that everyone is really at risk and needs to have flood insurance. But unfortunately, because of the government's program, only 4% of Americans have coverage today. Neptune is trying to change that. We want to get many, many more Americans protected from this most dangerous peril. You've seen these hurricanes when they hit, the tragic flooding that took place in North Carolina and in Texas recently. Neptune is here to make sure all of those homes are protected.
Trevor, is flooding is that a risk that is going up in frequency and in damage? And if so, why is that happening?
It's happening, the answer is yes, and it's happening because the climate is changing. It's undeniable that the sea level in Key West, Florida is nearly a foot higher than when I was born. The temperature in the Gulf and in the Atlantic is warmer than it was 10 years ago. That added heat is energy, and that leads to more frequent and severe storms.
So what's the growth story for Neptune? Is it more markets? Is it more policies? Is it driving rates higher? How are you guys pulling those levers?
The growth story for Neptune is helping educate the American consumer that their homeowner's policy does not cover the risk of flooding and that they need to buy a separate policy to protect their most valuable asset. If we can just help educate people on that fact, Neptune's going to do a great job at growing.
We should mention that Neptune is going public after a bunch of specialty insurance companies have gone public this year. Accelerant Holdings, Aspen Insurance, American Integrity Insurance, Slide Insurance. What do you think it is about the current environment that makes it so welcoming for insurance companies to tap the public market?
It's nice to have the market open, and it's nice that pricing in insurance makes sense. We want to make sure that that consumer is finding value, that the agent is doing well, that Neptune's making money, and it's sustainable for the global insurance and reinsurance community. I think we have some good equilibrium in the industry right now, and that's why you're seeing so many companies come to market.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Again, we've been talking a lot about AI. So has everybody in the marketplace really for the last 2 or 3 years. And now you've been looking for derivative plays. And a lot of the derivative plays have focused on who's going to power all these data centers. And that focuses on energy, fossil fuel energy, new energy, and even including nuclear energy. So everything seems to be on the table as these data center providers think about how they're actually going to power this stuff going forward. Scott Levine joins us. He looks at the energy business for Bloomberg Intelligence. He put together a global team and put out a huge report here and a really good report on nuclear power 2026 outlook. He's saying AI-driven power demand is set to spark $350 billion build cycle. Scott, thanks so much for joining us here. I love the big round numbers here. Talk to us about, from an energy perspective, what the industry is doing to kind of prepare for what seems to be this insatiable demand for power.
Yeah, so nuclear really has two very big positives going for it. Number one, it's a emissions-free power source, and the hyperscalers that are really behind the investments care about that deeply, right? And so they've favored, more renewable sources heretofore, like wind and solar. But what those lack are, 24/7 baseload characteristics, and for a data center to be up 24/7. That's not going to do it, right? Okay. So nuclear checks both of those boxes, and those are two very big positives, and the reasons that you're seeing folks like Microsoft and Meta come out in favor of nuclear power. And yeah.
So how much does nuclear provide today in the U.S. versus where you think it might be in 25 years?
Yeah, so today it's a little bit below 20% of the grid, okay. Which we're saying will return to about, in our base case scenario, 20% of the grid by 2050. That may not seem like much, 2 percentage points, right? But it, will equate to or amount to a $350 billion investment to get there. So those are big numbers. And in addition to that, we're talking about adding 60 some odd gigawatts to the grid. And you can think about each full-size nuke being 1 gigawatt. So that's basically building 60 generating units as our base case. So those are big numbers to get you from 18 to 20% over a 25-year period of time.
I tell you, I went in this report that you and your team put together, Section 5, small modular reactors. That's where I wanted to go to, because we've had some people come into the studio over the last few years and just talk to us about the science and the engineering and the possibilities of these small modular reactors. Tell us what they are and what role they could play going forward?
Yeah, so really, these are, and none of these have been built in the U.S. yet, right? So this is very much an emerging technology play. But basically, you're talking about is taking a full-size nuke. You're driving down the highway, you see a big cooling tower, bunch of smoke coming out the top of it. These are much, much smaller, right? And so the idea here would be that these are much more flexible. And so if you have more disparate data centers located throughout the country, you can power these ostensibly with these smaller units, right? And we're talking about, some of these are smaller versions of what's already in operation today, which is a light water reactor. And then some of these types of units are different types of technologies. You have gas-cooled reactors as opposed to water. You have molten salt-cooled reactors as opposed to water. And these use different types of technologies, different types of fuels, still remain to be licensed and proven. So a lot of it's very much on the come. But the technology in each of those areas holds promise. So we'll see, and each of them has pros and cons, right? And so we'll see over the next 5 years the technology shake out and see which ones end up being at the top of the stack for the U.S. But each of them have a lot of money behind them and a lot of support from a lot of deep-pocketed players.
Talk to us about this Trump administration. What is its view on nuclear fuel as an option?
Okay, so firstly, very positive. They came out with a bunch of executive orders in May where they have clear support. They're trying to streamline the licensing process. So these things they basically want to see 10 reactors in construction by 2030.
Okay, wow.
Okay, so yeah, and that's 5 years from now. It seems like a long time, but in nuclear world where it takes 10, even 15 years to build a reactor, which is what it took to build the only reactor that's been built in the U.S. in the last 30 years, took 15 years to build. That is not that long a period of time.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.